Okay, so over the last 1 week, we spent some time actually looking at the stock market, looking at mutual funds. Remember, responding to questions of should we take out our money, should we leave our money, and what to do. And several of you wrote in saying, bring an expert. Okay. So I got back in touch with the expert that I respect most of all, also the expert that I have used for my money most of all. So I'm hoping that this is the conversation you want to have, because I've also written down a lot of the questions that you put in the comment section, and we'll ask those questions as well. Remember, effectively we're talking about the fact that Indian stock market has been the worst performer among the global markets from October to date, and what that's making people feel and how you should react to it. So, joining me right now is Dhirendra Kumar, the founder, CEO of Value Research. For some people who will remember, Dhirendra Kumar and I had ran a investment show for, about 18 years ago for nearly 10 years. And the advice was, I'm suspecting sharply similar to what he's going to tell us today also. But Dhirendra, thank you so much for joining me.
Thank you.
India being the worst. First, I just want to understand what your, explanation is for what's happening in the market. Worst performer as an index, Sensex and Nifty, among most of the global markets. If we consider October 1st till today, FIIs are selling. Domestic investors have slowed down. Domestic institutional investors have slowed down. Why do you think this is happening?
So there are a variety of reasons. One is that there is simply a reversion to mean. Domestic Indian market has been on top of the pack, and you always have this intermittent correction. Second is that when you have a lot of favorable things going, then there is a significant part of the market or good part of the market or a small part of the market which goes ahead of its worthwhile value, and that became expensive. And that is the nature of this market is not a weighing machine of which you can stand up on any stock. You can judge the value of any stock and have a positive and negative opinion. Market
Yeah.
every day, the market is made up of people who are selling the same stock which somebody else is buying. So uh, so uh, I think people the- I think there is a reversion to me. A good part of the market has become very expensive. Third is that the global anxiety, Mr. Donald Trump might be, good for America or whatever, but he has caused great anxiety, great
Yes.
uncertainty about many businesses, many sectors, and the outlook. And we really don't know. Today, if I have to think of the outlook for Infosys, I can, uh, there is a question mark in terms of how, one is the uncertainty about the business because of other dimensions, AI, how the business will get reorient itself with the changing dynamics, what it will be its role. On top of it, our role in the businesses, because in this integrated world, suddenly we are stepping back and saying that no, we don't have to integrate this strongly, and it has to come with riders. It has to come with
Yeah.
it will come with these question marks, or we have to really sit down on table and decide again. We will sign the deal again. Uh,
Yeah. The
I
world is
think
not flat.
it's not flat. So if we have to rethink about and I think that is not a changeable thing. World will largely remain positive and flat, but because economics uh, is still the primary driver, but all these anxieties is not liked by investors. And I think we are still, and I there is every reason to be very optimistic, and there is every reason why domestic investors should not panic. But the reason why domestic investors to an extent are also panicking, are in a state of panic, simply because we have seen the massive explosion in last 4 or 5 years. Those are the investors who don't have the experience of a declining phase of the market. They think the market has only goes up. The number of investors going up in India has doubled in the last 5 years, who invest in stock market or through mutual fund. This is not a small number. All that thing that we have done in the last 30, 40, 50 years, the same number getting added in last 5, 6 years, is that big. When we were doing investors guide, I used to tell you that a small cap fund which becomes 5,000 crore and more is too big. Today we have 50,000 crore worth of, a small cap fund which is 50, could well be 50,000 crore, or we have 1 lakh or 2 lakh crore worth of an index fund,
Yeah.
and it sounds normal. So we have to really, I think, there's too many reversion to mean and greater uncertainty. But I don't think, people have the sense of proportion. They don't have the perspective, because you look at the worst of category, the small cap fund, which has been the most fancied sector, or the category of fund that has gone back in town, gone back in time by about a year. And so last 1 year return is minus 3 or 4% as of Friday. Now this is, if you lose 3-4%, and if still the 3 year return is 15% annualized despite this decline.
Hmm.
So I think one has to think that yes, the active punters, the traders, short-term investors, they have every reason to panic. Tide has turned. But long-term investor doing their SIP, should they worry? No, they should feel very happy.
So I do want to ask you this though. Do you believe that this market is correcting because it was overvalued last year? Over the last 2 years, there was a lot of talk of overheated stocks. We don't have the fundamentals. The companies are not sounding positive, but the stocks kept running up. Or do you believe we are now in a bear market? Or is this, as some people have asked us, a free fall?
No, it's not a free fall. It's not a bear market. Market has gone down, and the frothy part of the market has gone down much sharply. And if you look at three things in a company, if the company is growing, if the company is making profit, and if the company has modest margin, I'm not talking of hefty margin. If you just take these three things, any company with these three variables in place, and if this company was not above 50 PE, it has not gone down. It has not gone down meaningfully. It has not gone down to any extent that you can say that it has corrected. So I think, frothy part of the market has corrected, and rightly so. Some people who, investors who were investing only in the speculative momentum, frothy part of the market, and they will lose money. And that part of the market will also not turn around in a hurry. We should not lose the sense that, in Indian market, 4,500 stocks are traded somewhat frequently. At least 90% of these 4,500 stocks are traded 90% of the days, 250 days in which stock trading happens, of which, about 2,800 companies don't make profit. The number of the mutual fund universe of stocks in which mutual funds invest is just about 680 stocks. The remaining 120 stocks is so insignificant, it has gone down in value. So if you look at the stock universe in which investors invest in, and where they lose money, where the speculation comes, where people rig those prices, where SEBI is after all those kind of advisors from Indore who are calling people to trade their way to poverty. I don't know about them, but if you are a sensible, thoughtful, regular investor for the long run in equity, you have to do very few things. And if you have done any of these fact checking, any of these, basic checks before investing, then I don't think this will be causing great sadness, or you will be regretting that you invested in the market the way you come across in a certain segment of a new investor.
So a lot of mutual fund investors were getting in touch with me last week saying, "Oh, it's all of the gains are starting to now erode. So should we take our money out before we go into the negative?" And when you and I were chatting a little earlier, you said something really interesting. You said any 5 year period of the market will have these patches. So first of all, should mutual fund investors exit at all? And explain the 5 year period theory to me.
Yeah, as I said, that any 5 year period, if you have done your SIP, you have not only generated positive returns, you have beaten the then available fixed income return by a, if you have started investing at the worst of times and continued investing for 5 years, you will be making 1.5, 2 times of the available fixed income returns. Assuming you started investing in January 2008, which was the peak of the great, well before the great financial crisis. And if you blindly, you just set up your SIP, and you disappeared for 5 years. And which means that every month you were investing, it was going down. Or assuming you did the same exercise in 2007, or you did it in 2006, and you saw the huge surge and then the big decline. The surge is very steady. Normally, it goes up by 10, 15, 20%. As the saying goes that the markets go up by the staircase and they come by the elevator. So you will always have this very jerky fall in between. So if anybody has done this investment for 5 year period, point to point 5 year period,
Yeah.
you will beat you will have more return than fixed income, or you will not have negative return. If you have done your SIP, then you will actually beat the fixed income return by 1.5 to 2 times over any 5 year time period. And this is the power of compounding. This is the power of averaging. And this is also a reward of patience and reward of investing through the bad times. Investing through the lean times is the most important thing. Actually, investors get very excited to invest when the market is going up, and that is exactly the
The
wrong
opposite of
thing
what
to
you
do.
should be.
Opposite one should be doing. You see you go to a big bazaar and you see this big sale, and then you think of buying little more. And when it comes to such situation in the market, people say, let's stop our SIP. It's just the opposite of
Yeah.
what is going, what typically one should be doing.
So your argument is that if you're a mutual fund investor, it is likely that even though the momentum stocks, the mid cap stocks, the small cap stocks have fallen, your mutual fund, if chosen well, would have not fallen as much.
Not at all. It has, in fact, the worst of fund will be the sector fund or a thematic fund, which was launched in the last 3, 4 months or 6 months. And this is where the maximum pain is, because this is where the naive investor who does not understand, who does not question, he was getting attracted by the hoarding or the promotion of this defense fund or that fund or the EV fund. Even there, I find that it has gone down by 15, 20, 25%. And I have one message there. One is that if you have invested your short term money, if you are likely to need this money in next 6 months, 1 year, might as well square up your losses and take your money back. But if you have taken this decision, the worst of mutual fund, a thematic fund, I am not questioning the premise of those. I am questioning the timing of those. So if you can act, if it has gone down by 30%, I have great belief in the EV fund. Though I would not recommend any new investor to invest in it. I would not recommend any new investor. I have always been saying that never invest in a sector fund, never invest in a thematic fund. But if you have done it with an understanding that this is a promising sector or a theme,
Yeah.
by all means, invest in them. Do your Start your SIP while it is down, because they are not bad choice, and the benefit of diversification in a promising sector or a theme can be hugely rewarding. But this will always be cyclical. So if you invest today, if you start your SIP, if you have made 5 lakh rupees investment and you are disappointed that it has become 3.5 lakh rupees, uh, don't write it off. Maybe make good use of it and note down the lesson that you learned. You have paid for it.
In fact, also I also believe this. So, for example, let's assume someone did invest in a defense sector, index or a fund, or an EV fund, if that's what you have chosen. You've done it because you believe that there is a story within India's defense sector that's going to play out over a certain period of time, or there's a story within the electrical vehicles market
Yeah.
that's going to play out over a period of time. So, this correction in the market has not changed that story. You would
Absolutely.
necessarily need to believe in that story and not change your mind about it. This is actually about something that's happening halfway across the world and not necessarily something that's happening in India. So I do want to ask you this though. A lot of the economic analysts have been telling us, a lot of the FMCG companies are telling us that consumer spending in India has come down, especially in urban India. People are not buying products, which is why corporate earnings are lower, which is why the stock market is now sort of becoming, reacting to those numbers. And also, we're not creating adequate jobs in India in order to leave people with money to buy those products. Do you expect that to change or not? Or What impact will that have on our investments?
I don't know. These are very big questions, and they require a different might of an economist who will have a far different perspective, or uh, greater insight into how things will evolve. Uh, I look at things that in my surrounding. If all the economic policies that has been initiated, uh, it is a ever changing. This is actually like a work in progress. It is actually a very dynamic thing. If people are buying houses, somebody is fixing curtains and somebody is building it and somebody is constructing it, somebody is painting it, and you're buying Asian paint. And our aspirations are a moving target. We are changing our phones every 2 3 years. Somebody, so India is a very complex market, and it's very difficult to segment the dynamics. Yes, I think we as a country we have a huge problem that if we have so many people who are dependent on food from the government,
Yeah.
uh, and something as basic as that, and if we have a lot of people who are educated but that they are not skilled, I think they are different kind of macro challenge, and it needs to be dealt with. And this is where I think, if there is some kind of you know all the policies should translate into some unleashing, uh, and the infrastructure initiatives and other things. But I don't know, these are too big a question. I'm hopeful that the narrow of market that we are used to, the 4,800 companies, of which 6,008 7,700 companies in which mutual funds invest in, this is a very promising and a driving segment of our economy. And government needs to reform a lot
Yeah.
of things, and I don't know what is the timeline of it, what impact it will have, what will be the short term impact of all that. But going by the earnings that we are paying for of the underlying companies through in which we invest through mutual fund or by buying stocks, I think I'm very optimistic that we have good days, still the best days ahead of us.
That's good to know. A couple of specific mutual fund questions. Satyam wrote in and he said, if I do an SIP in small cap, mid cap, large cap indices, should I allocate more to large caps at this point?
Ideally, he should not do any of it. Ideally, he should invest in BSE 500 where things will keep getting rebalanced. Uh, but if you are investing for the very long run, there are two ways of looking at it, riding the momentum or being a contrarian. uh, if you have to invest in something which has fallen more, uh, in fact, if you allocate a defined percentage of your money every month, uh, it will be taken care of by something which has become cheap or has gone down sharply. You'll be buying more of that. If something which has gone up, you'll be buying less of that. So the averaging will work with an equal allocation as well, or a defined allocation as well. But my sense is that it's entirely a matter of your risk tolerance. If you are investing for 20 years, if you are investing for, and if you are not losing your sleep with the fall in the value of the small cap funds, uh, then might as well have 31 third of your allocation in small cap funds. If you lose your sleep because of this, get rid of them and invest in a flexi cap or a multi cap fund. It will not be visible and you will not lose your sleep.
Right. So you need to have the stomach to actually have small cap funds. If you're the kind of person who can hold on to it and not freak out, then it's a good thing. Otherwise, just a flexi cap fund which can move across the market without your necessary permission would be the best way to do it. Shankar Nanda said, is it a good time to invest in global markets? How to access global markets? We have a few funds that can do that for us. Do you recommend them?
I recommend them, and I recommend them very strongly. And I started recommending it in Investors Guide as well.
Yeah.
One of our aggressive growth and growth portfolio had a very meaningful allocation, and that particular allocation has done the magic in those portfolios. In fact, the only avenue which was available then was Nasdaq 100 index fund,
Yes.
and
Yes.
that was one of our, and we had made an allocation of 20% long time ago, maybe 14 years back. So I would say that it is very important to invest in that. And in fact, it is important to invest. Everybody was trying to try his hand with a 5-10% allocation. I think if possible, I would rather be investing 30-40% for two reasons. One is that, when it comes to looking at companies which are attractive, which are promising, which are scalable, and with greater outlook, and a kind of company which is not available to to Indians in the domestic market. That is one. The second reason is that my job is here, my profession is here, all my assets are here, and all my investments are here. De-risking myself. It's a very meaningful diversification, which is the goal of any diversification. Do it through a mutual fund simply because all other avenues are they carry great deal of it is a headache. First remit the money, put it in a broker's account, file your return, and make sure that you are not violating the foreign exchange regulations. And mutual fund is able to eliminate all that hassle. You are investing, in rupee from your bank account and the tax regulations are also very simplified and transparent now. So one should invest for superior return, enhancing the return, superior diversification. Unfortunately, all the good vehicles have shut down. Government had a rule of there was a ceiling that every fund can invest through ETF or through actively managed fund, but still there are about 10 funds available, and one should invest in them to the extent possible.
I do also want to ask you one question that's come in saying that, okay, if I want to exit my mutual fund right now, there's also the fund management fees, there's tax on top of that. It'll wind up wiping out almost everything I have. What's your response to that?
No, if you sell your fund, you don't all the expense in a mutual fund is factored in the daily NAV. There is no extra fee. Only if you are redeeming your investment before 1 year, within 1 year of your investment, that an exit load will be levied. That is also 1%, typically 1% or less than that of the money. But hold it for 1 year and then sell it. That's one. Second is that if you are sitting on gains, yes, this is the law of the land. 12.5% for long-term gains on equity mutual fund that you have to pay, and you pay only on the gains, not on the total value.
What is your expectation long term from an equity diversified fund in India? Do you expect 20% annualized or is it likely to come down?
It's a very difficult question, and it will require a very different kind of foresight or astrology. But I'll tell you how I look at it. I think that the equity premium will be at least 1.5 to 2 times of the fixed income returns available. And if interest rates come down to 6 to 8%, then I think equities will be able to deliver 12 to 16, but somewhere in the band of 12 to 16%, which will be a decent return on a diversified equity portfolio of a well-managed portfolio of equity.
And finally, a couple of things, yes or no from you. Bitcoin?
Absolutely no, and have fun. Make your allocation uh, uh, because I still strongly believe about the underlying, the worth of underlying. So good till it lasts.
Physical gold or gold ETF?
Gold ETFs, if it is an investment, and not even physical gold. If you are going to really own it and show it off, buy the jewelry.
All right, Mr. Kawar, thank you so much for answering all of those questions. It is a pleasure to chat with you. And for our audience, I hope you found this useful. If you want more information, write to us at the bottom. Remember to like, share, subscribe, sign up for our membership. Dhirendra Kumar's advice is available on valueresearchonline.com. He's been building it for decades. It is really the place that you need to be if you're really looking for good data and good advice on mutual funds. So go check it out, sign up for their membership, and be part of that family that understands how the market and mutual funds actually work. Thank you so much.